Okay, US dollar versus US 10-year yield suggests there's nothing the BOJ can do to stop JPY from hitting a 170 and maybe even 200. Equals there's nothing the US can do to stop the US Treasury yield from hitting 6% and maybe even 9%. If we don't believe the latter, I don't, how can we believe the former is true? You know what? From some of the outlooks I've read so far, that seems to be the consensus, is that US yields will not move higher from here. And I think people are getting ahead of themselves on those expectations just a little bit. They are reasonable expectations, and they are the consensus expectations. And I would be in line with those views. But I think we're putting the cart before the horse at the moment with all these outlooks that are saying, hey, over the next 2 or 3 months, there is, no likelihood that the US yields go significantly higher than or to the Fed cash rate. I mean, guys, rate hikes are still a thing that can happen, especially if growth in the United States doesn't slow down enough, including if employment doesn't slow down enough, right? If employment still holds up, if consumer spending still holds up in the United States, if just growth metrics net hold up in the United States, and then at the same time you have inflation not moving over the summer, you cannot rule out that a rate hike could still be in play here. There's a lot of uncertainty over pretty much up until July, I would say, that we don't necessarily know if it's, the nominal thing is to say, oh, well, of course we're not going to see any more. We're not going to see yields go significantly higher from here because they're already so close to the cash rate. But if it becomes reasonable to begin expecting the Fed to hike, then we will see those yields go higher. And that would send this dollar yen higher. That would really make the dollar super, super, super freaking strong. And that view is being discounted very heavily. So I wouldn't be totally throwing that idea out with the bathwater, right? And it's, in my opinion, still too soon to say, oh, the dollar's going to get weaker from here. Well, what if in 2 weeks from now we get the April economic data and it still goes along those lines that I just outlined for the rate hike scenario? Like, that really could screw up a lot of people who position now for those yields to stop increasing from here. So there's significant risk to people who might be, frankly, positioning too early. Don't get me wrong, there's good reasons and good expectations to have for falling yields. But you get this next bout of economic information and see the US still growing incredibly strong and inflation still holding up, and then you get the April data here upcoming in May, and then you get the May data in June, and then you're getting the June FOMC. If the June FOMC says, oh, we have to look at our probability of a rate hike potentially, it'll send these yields to insane levels. That's over the next 2 months. That's a real risk that could be in play still. And that would keep the Fed super higher for longer. Like higher into the middle of 2025 longer.